Good morning and welcome everyone to the Money Control live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Indian equities are set for a lower start on Tuesday. If Nifty indicates a somewhat subdued start coming in for Dalal Street, Wall Street posted gain as investors eye rate outlook. Let's also talk about Asian stocks. They've sunk in early deals on hawkish Fed outlook, China fears and persistent, which continues to weigh on the sentiment. In terms of FII, they've sold shares to an extent of 2,333 odd crore and DIIs have bought equities to an extent of 1,579 crore. Measures, a bunch of them are taken by Sebi, essentially two of them. We are going to be addressing that in just a jiffy. But let's actually first go across to what we have in terms of the FIIQs. In also FNO, beg your pardon, in terms of the index options that we're looking at. FIIs have been net sellers to an extent of 1,466 crore. They've also been buyers on the other hand for index options. They've been buyers for stock futures. They've been sellers for Bank Nifty futures and also sellers for Bank Nifty options. So essentially, more or less, they've been sellers for Bank Nifty options as well as the index options. If you talk about the FNO ban, what comes new in the ban is Balrampur Chini. What still remains in the ban is India Bull Housing Finance, Hindustan Copper, Canara Bank, Granules. What comes out of the ban right now is Delta Corp, Manappuram. These are essentially the counters that you need to keep a close eye out on. But let's get to know more about the trade setup, strategy of the day and FNO updates with Aamar Deo Singh, the Senior Vice President at Angelone. Morning there, Amar. What's the strategy for the day?
So what we've been witnessing in the major markets, I would say the indices, is that more or less we are seeing some sort of selling pressure. And also if you look at the derivatives data, that clearly tells us that there's selling pressure at higher levels. However, what we see is that Nifty is very strongly supported around the 19,600 mark. So that's a very strong support zone where we see some bounce back. So any pullback towards that level can be used as a buying opportunity because we could see some spike from those levels. But on the upside, 18,850, 19,850, 19,900, that's a major zone of resistance. So this is a zone that one should definitely look at playing out because technically, if you ask me from a short-term perspective and even from intermediate-term perspective, it seems that the momentum has slowly come off. In spite of the medium-term trend, the long-term trend remaining positive and in an uptrend, the uptrend remaining intact, the short-term we are seeing some sort of consolidation, but any correction towards these levels, 19,600, 630, that can be as a buying opportunity with an upside target of 19,750 or so. But one needs to remember that this is more of a trading range. The trend is missing right now, and that is confirmed by the derivatives data also, where we've seen some short build-up happening in the last couple of days.
Sure. And what's the strategy now for Bank Nifty, along with two recommendations that you have for our viewers early this morning?
Yeah, sure. So Bank Nifty, I would say, is comparatively is on a weaker footing as compared to Nifty. That I've been saying for quite some time, and we've been seeing that play out in the markets as well. On the downside, Bank Nifty's got good support coming around the 44,200, 44,300 zone. That's a zone of support countries around 44,700 odd levels. But again, on the upside, 45,000, 45,100, that's a zone of resistance on the upside. So this is the range that one needs to look at from a trading perspective. Again, it's more of a range play. It's a consolidation which is being displayed. Talking about stock specifics, the first stock to look at is Bharat Forge. This is one stock, what we've seen is that the stock has held out. We've seen some sort of correction in the stock, but the stock has held out. It's very strong on the long-term, intermediate-term trend. Short-term, we've seen some the stock witnessing some sort of correction, or I would say profit booking. So any pullback towards 1,080 odd levels can be used as a buying opportunity in the stock with a stop loss of 1,041 and a target of 1,143 on the upside. And the second stock to look at is Coal India, because this is one stock, in spite of the market correcting, this is one stock which has bucked the trend. And technically, if you ask me, the stock continues to be very strong and the momentum continues to be very strong on different time frames. So that clearly shows that the stock is not going to correct in a hurry. So this is the second stock one can look at. Any pullback towards 278 to 80 levels can be used as a buying opportunity with a stop loss of 267 and a target of 297 on the upside.
All right, Amar, we're just going to get back to you in a bit after addressing the markets, but there is a pressing issue that we need to address. In fact, a development which has taken place that needs to be talked enough and more about. And it's essentially about the Sebi finally extending in the additional surveillance measure for trade settlement for SME segment. And to take us forward and provide us more color on this development, we're being joined by Yatin Mota, the associate editor at CNBC Awaaz in the studios today. Morning there, and thank you for joining us. I'm going to start off by asking you the basic details of the development and the implications, because I believe CNBC Awaaz was the first to report about it, that this is about to take place, and it's come through overnight. What do you make out of it, and how can viewers look at it?
So, Nickey, good morning, and thanks for having me on the show. Now, if you look at the SME segment, these are essentially micro caps which are prone to higher manipulation and volatility. And Sebi has always taken cognizance of market manipulation and keeping retail insulated when it comes to market manipulation and stock price rigging. Probably the SME segment saw many companies which have run up despite of weak fundamentals, and probably taking this into account, Sebi had a discussion with NSE and BSE, and finally yesterday post the market hours we had a big circular coming in from both the stock exchanges regarding surveillance measures for SME stocks. Now, these are two surveillance measures which will be considered every fortnight. So every 15 days, SMEs will be scrutinized for any kind of abnormal move which comes in. Now, number one is the ASM segment, which is additional surveillance measures, which means that higher margin outgo would be seen in all of these SME stocks once the exchange identifies the stock under the ASM. Obviously, ASM has several criterias. One of the main criterias would be a 25% move or a 25% beta to the Nifty 500 stocks put together in the index. And secondly, the exchange is also notified about the T2T regulations, in which probably intraday trade cannot happen in SME stocks once the stock goes into the T2T segment. And more importantly, upfront margin is required to trade T2T stocks. So both T2T and ASM put together probably is being looked at stock exchanges to curb the excess speculation and the manipulation which is currently seen in certain SME stocks.
All right, this is going to happen over and above the measures that are already in place, and what does essentially mean for SME stocks? Anything specific that we can look at?
No, there is nothing specific, Nickey, but SME did not have any particular regulations or additional surveillance measures. It was normal circuit filter with changes. The main board stocks had ASM, GSM and various surveillance measures, but SME is probably under-regulated in the country. We have the financial reporting also, which happens 6 monthly basis, and SME stocks trade in lots. No single share can be bought or sold. Probably because of that, the exchanges have taken this seriously, and initially to start with, ASM category 1, category 2 as well as T2T segment has been introduced for SME stocks.
Right, Yatin, thank you so much for taking out the time and giving us color on how does this work exactly. But we're going to be addressing in the markets open in just a jiffy. Of course, we are looking at somewhat subdued start coming in for Nifty 50, 19,650 mark, well above that level, but a flat start with somewhat a positive bias. Remains to be seen how does it trade. It is an F&O expiry week, so a bit of volatility is expected. Do bear in mind that yesterday also we saw some amount of subdued start coming in for markets, a bit of drubbing later, but it is a lackluster day for Nifty 50 right now, at least a lackluster open, if I may put it that way. Let's talk about Bank Nifty. How is that stacking up and how is the trend really working here? 0.2% of loss coming in for Bank Nifty index, 44,650 mark, sitting well above that level, but losses to an extent of 0.25% already clocked in by Bank Nifty in early deals. RIL and HDFC Bank are the two index heavyweights who thus far haven't really participated in the participation of the rally, or let's just say the upside of the markets. Those two stocks need to be seen individually. Let's talk about RIL. Well, a bit of support already being given by RIL early deals. Perhaps that's the reason also you're seeing some amount of flat The losses to an extent are capped by the gains that we're seeing by the heavyweight. Not a big momentum, but at least there to support the market sentiment. Let's also talk about HDFC Bank at this point of time. Well, it is down and out, 0.25%. Just how we're seeing the impact coming in even for Bank Nifty index. That's the one which is probably weighing down on the sentiment a bit for the markets. Let's also talk about the mid-cap index and the small-cap index. Mid-cap, a bit of outperformance. The trend continues to hold up for the mid-cap stocks, and small-cap acting no different. 0.4% of gains clocked in for the index overall. Let's also talk about the sectoral indices that we have early this morning just to see how's the flavor stacking up in terms of market. IT with losses to an extent of 0.1% in terms of what we have for pharma basket. It is a 0.25% gains coming in for the pharma index overall. FMCG seems to be doing too well too. 0.25% of gains coming in for the FMCG basket, and metal acting no different. Perhaps a bit of outperformance coming in from that one. 0.5% of gains clocked in by metal index, along with auto, which seems to be right now in motion. 0.3% of gains coming in even for the auto names. Select auto names, realty index participating a bit on the upside. 0.25% of gains coming in even for the realty index. That's the one that we're looking at. Let's also address in advances and declines before we graduate to the top gainers. Advances 32, declines 15. Clearly the market trend is in the favor of advances. Eicher Motor, Tata Steel, Tata Consumer Products. These are some of the top gainers that we have, apart from L&T, DRL, and of course Titan for that matter. Also, let's talk about the other top gainers that we have on the screen. Ultratech Cement, JSW Steel and Bajaj Auto also are doing well in early deals. Well, let's talk about the top losers. Asian Paints, Apollo Hospital and TCS. These are some of the top losers that we have today. Kotak Mahindra along with HUL and ICICI Bank. These are some of the, look at that, Axis, Indusing, HDFC Bank. You have the entire financials which are down and out in trade today, and hence you see that weakness clearly creeping in. In the previous week, again, it was dragged down by the financials. And in this week, there is no breather, or let's just say solace coming in for these private sector banks. Let's also talk about PSU Bank. How is that stacking up? Just to see if there is a dichotomy, in trade in terms of how we're looking at. Look at that, gains coming in for Nifty PSU Bank. It's clearly, quality over momentum. That's clearly not the phenomena that's working out in the favor of the market. PSU banks are being chased. Let's just say 0.5% of gains coming in for PSU Bank index right now. We're going to go back to Amar and check with him what does he actually make out of this. Another day where there's a complete divergent trend which has been playing out between the PSU and the private sector banks. HDFC Bank, Axis Bank, IndusInd Bank, all of them are down and out in trade today, clearly dragged by the financials. What do you make out of it, and what's your preferable bet within the private sector banks right now?
I would say see a complete divergence in trend in private sector bank and public sector bank. And earlier, if you go back in time, we would have seen it being favorably played in the favor of the private sector banks. So currently we are seeing HDFC also in a serious, correction mode, but it does have some support coming around the 1450, 1500 levels. So HDFC, I would say that there's some support there for HDFC. Looking at ICICI seems to have not corrected that much. It is forming some support base around the 930, 950 zone. So that's one stock where I would say the bank can pull back. We could witness some pullback because that's a very strong support zone for the stock. Earlier also the stock had rallied from those levels, but again on the upside seems to be capped around the 1000. So it's going to be around 900, 920 on the downside and 980 and 1000 on the upside for ICICI Bank. So amongst the private sector banks, I would say one can look at ICICI Bank, but from a short-term perspective, do not expect any major rally happening here.
How about PSU banks? A bit of outperformance. Perhaps a session of two of dips came in for PSU banking index, but the momentum continues overall.
Yeah, PSU banks have been really, if you say they've given a stellar performance and returns to investors, and we've seen no signs of decline in momentum. So talking about PNB, we've seen the bank really moving strongly up. So currently it's around the 80 odd mark. So what we are seeing here is that once it starts sustaining over the 83, I would say 83, 85 zone is a very strong resistance zone for PNB. Because if that is taken out, then the stock is definitely likely to witness higher levels towards the 98, 100 mark. So this is one bank one can look at because among the PSU space, because the momentum is very strong across different time frames. So that really tells me that any dip in this or any correction should be used as a buying opportunity, and one shouldn't think that the rally seems to have ended. So amongst the PSU bank, this is one can look at. And if I look at the other bank, if I look at SBI is more or less a range play, but it can be a very good trading opportunity for SBI. So on the downside, somewhere around, currently it's around 590, 594 odd levels. I would say the trend is positive. So any correction in this stock can be used as a buying opportunity somewhere around the 570, 565, 570 zone. But again, on the upside, one needs to be clearly aware that the stock has got a resistance around the 610, 620. But apart from SBI, most of the public sector banks, the trend remains extremely strong and positive, and the bulls have a very strong upper hand as compared to the bears, and there's no signs of consolidation also. So it's more of a trend, very strong uptrend.
All right, Amar, we're just going to leave it at that. And thank you for taking out the time and giving us those views.
Thank you for having me.
All right, let's address the stocks and news quickly that we have before we navigate our fundamental discussion out there for you. Voltam Transformers, this is the one which is top at the stack for us. Promoters are planning to sell up to 12 lakh shares. That's going to be happening through a block deal. Over 10% stake will be offered. Floor price is 4,600 per share. 7% discount has essentially been offered as compared to the current market price. That's the one that we have from the sister concern, CNBC Hours. Let's also talk about Bajaj Finance. Do remember the fact that it was a good day coming in for Bajaj Finance. In fact, Bajaj Twins. But today, the slew of brokerages that have come across, the street seems to be divided on the way this can be seen. The entire fundraising can be seen. HSBC has maintained the buy rating, target price to an extent of 9,500. Right now, the stock is sitting at 7,700. And it said that, to convene board meeting on October 5th for approval to raise equity capital despite 23% Tier 1 ratio. The company's growth aspirations have only increased given benign condition, new launches, and the capital that they're holding at this point of time. They raised an AUM and the EPS growth estimate for Bajaj Finance. What Goldman Sachs, on the other hand, says, and perhaps is reading between the lines, it's gone ahead and said for the sell rating, target price of 6,716 per share. It said that the board meet for capital raise is, right now it's awaiting, the brokerage is awaiting more clarity on the utilization of the proceeds. It also is believing that investor will like to watch out for the key purpose of as to why the company is right now raising that amount of fund. Is it due to the competitive intensity, which is set to rise with Jio Financial finally entering into the consumer durable space too? There is going to be an aggressive growth targets beyond 30%. Management has also talked about it earlier. So bit of competitive pressure because of which the fundraising is happening. Then you can look at consolidation and perhaps the sell rating has been justified by Goldman Sachs. Let's talk about Strides Pharma, where the board has approved a demerger of its CDMO and soft gelatin business into Stelis Biopharma. Now, the demerger is expected to take place by April 1st, 2024. The shareholders will get in 1 share of Stelis Biopharma for every 2 shares held in the company. Right now, look at the counter. It is a development which perhaps is not found liking with retail community. At least, the investors out there aren't really liking the way this has panned up. And the stock is right now down and out with losses to an extent of 2.5%. But it is a day which is dragged in by the financials, and we need to chat about it enough and more with our fundamental guest, Siddhartha Khemka, who is the head of retail research, broking and distribution at Motilal Oswal Financial Services. Good morning there.
Good morning.
All right, a bit of divergent trend which was technically taken place with PSU banks and private sector banks. And today the divergence is just more evident with the way Axis, HDFC, perhaps more banks are reacting, and PSU bank index overall doing pretty much well. How are you looking at both of these? What do you like, and which valuations are supportive for Which of them at this point of time?
Yeah, good morning, Nickey. So I think if you look at what is happening in the market is that with the global pressures and a bulk of the FIIs selling happening, holding within the private banking space, which is why we are seeing that with the FII selling intensifying in the last couple of days, banking is under pressure. Within that, the PSU banks are kind of outperforming because of two, three reasons. The earnings growth has been pretty strong compared to the private banks. Private banks have been delivering the steady earnings for the last 2 years, but the momentum in terms of earnings for PSU banks just started in the last couple of quarters, and hence the results expectations for the near term is also on the stronger side. They are under-owned and hence not much selling happening there. Instead, there is a lot of buying that is happening within the PSU banking space. And the third and most important is that the global interest rate cycle has yet to peak out, and with the Fed commentary suggesting that there could be one more rate hike, and that has led to a kind of the bond yields rally globally. That is kind of putting pressure into the banking stocks. Conversely, India, there is a talk of the Indian bond market getting added to the JP Morgan index by mid of next year, which would be beneficial to all the banking stocks, but major beneficiaries would be the PSU banks who hold a large chunk of the bond portfolio, and there they would see a large, a good mark-to-market profits, and hence the current rally in some of these PSU banks. So within the PSU banks, we definitely like the larger ones like the SBIs and Bank of Baroda's. But one stock that we particularly like is Can Bank, which is reported its highest ever operating profit and as well as net profit in Q1. Business has been pretty strong. Loan book growth was at 15%. NPAs improved on a sequential basis. Net NPA at 1.6%. Management has been optimistic and has further guided for a net NPA of 1.2% by the end of the current financial year. So overall, we are expecting the advances growth of about 12 to 14%. With PCR of 90%, and we are expecting the ROAs to reach 1.1% and ROEs of 17%. So all this put together, valuation still looks comfortable for Canara Bank. We have a target price of 425 from a 1 year perspective on Can Bank.
All right, for Canara Bank, a bit of I would say a bit of things that one needs to perhaps watch out for is that the bank has a low return on equity of 10.4% over the last 3 years. That's also the case with most of the PSU banks. Perhaps needs to be seen if that cycle can be reversed. And of course, the promoter holding has decreased over the last 3 years. But Siddharth, let's talk about more of the gaming companies, right? Delta Corp, we saw a sharp crash to an extent of 16-17% after there was an announcement with regards to the GST demand which came through, which seemed to be way higher as compared to companies' last 3-4 years profits, and also in terms of the market capitalization, multifold growth out there. In light of that, do you like something like a Nazara better, or would you still think that Delta Corp is a buying opportunity?
So, Nickey, we don't follow these space as of now, but if you look at what has happened in the recent past with the GST Council coming out with additional, so the GST calculation methodology changing from the gains to the entire bet, that is a big negative for the entire gaming industry. However, what we see is that while Delta is directly impacted by that, some of the other players like Nazara are not to that extent. Only a small portion of Nazara comes from entire betting, but a large portion comes from what you call as technical skills, or that it's not purely betting. So I would say that until there is clarity in this space, this is a new age space, be it Delta or be it Nazara, one needs to be careful because the regulations are not yet clear. There can be changes, and that could lead to volatility in the near term for all the gaming stocks.
All right. Now that we're on the theme of, let's actually talk about IT. There's a bit of divergence there. IT stocks have done well, and if you see just the month-to-date performance for Nifty IT, it's 4.6% uptick that we've seen, at least on YTD basis. Also, the stock have done well. How are you looking at it? Because Q4 FY23 and Q1 FY24 earnings weren't really, impressive for the entire basket. What is leading to this buying? Why are we seeing some amount of healthy traction and buying coming into these stocks?
So, Nickey, as you highlighted, yes, the results have not been encouraging, and more so if you see the outlook, that is also not pretty strong, at least for the near term. And we have seen companies after companies lowering their guidance for the current financial year. So I would expect that in terms of earnings, IT would remain subdued. But if in terms of stock price movement, if you look at the lot of these heavyweight stocks in the IT space have already seen a lot of selling and battering in the last couple of quarters, and valuations have come off from their peaks. So I think within the current volatile environment, what is happening is that a lot of these funds are turning towards defensives, and that is where you see that some of the consumption names have also started picking up pace ahead of the festive season. And I think that is where some of the IT stocks are gaining traction, more from long-term investors looking at defensive plays and where the downside may be limited, because bulk of the worst is already known by the market. They have been factored in. So there looks like a limited downside. For the upside of momentum, I think people will have to wait for 1 or 2 more quarters. If someone has a longer term horizon, then it is a good sector to start picking up, nibbling on these some of these large names from the IT space, because the long term trend or the long term visibility does not go away. Some of these companies have been getting large orders. They have been partnering with some of the global giants. And we know that digital and cloud and all those things have only added to the overall portfolio for Indian IT services companies.
All right, let's also understand, what do you make out of the entire cement basket right now? The pricing environment is improving according to the channel checks of various brokerages. There is a substantial hike even in cement prices in South, followed by that of East. What do you like? Do you like mid-cap space in the cement basket probably better than that of large caps? How are you looking at it in terms of valuations?
Yeah, Nickey, so I think there are two sides to what the price hikes is suggesting. A is that definitely they are seeing improved demand, and that is why they have been able to push on these price hikes. But on the other side, the costs have gone up sharply, and that we have known that coal prices, crude prices, so energy prices have definitely gone up, transportation costs have gone up. So that is kind of impacted them earlier. What we see is that there is a lot of new capacity coming up, and hence, while the near-term price hikes will definitely help in the near-term quarter, but on an overall basis, we don't expect a sharp improvement in profitability. So we are expecting a stable profitability for the entire cement basket. Having said that, some of the players which we definitely like because of the entire theme of capex that we believe is doing well and would continue to do well, including the infrastructure companies, the housing space, which is all helping the improvement in cement demand. So our preferred picks within the cement in the large cap is Ultratech Cement, which is our preferred pick that we like. In the mid cap space, we like Dalmia Bharat as our preferred pick, which is largely focused in these regions, eastern, central regions, where they have been able to take the price hikes. And Dalmia Bharat has been a efficient player where we have seen improvement in the EBITDA per ton or the profitability on a sequential basis, which we believe would continue to happen given their niche presence, and that helps them to price better.
All right, Siddharth, we're just going to leave it at that. And thank you for taking out your time and joining us this morning. All right, with this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us in the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Money Control app.